and that's managing post-lunch drowsiness. Okay, so we will now turn to one of the most sensitive and far-reaching aspects of the transition, where benchmark reform meets South African households. The following session is Tough Legacy Contracts, the Case of Mortgages and Securitized Loans. We will have a case study presentation by Abdul Ismail from SA Home Loans, and this will be followed by a panel discussion on the legal, operational, and governance implications of the Jibar cessation. The panel will be moderated by Mluleki Shongwe, who is the head of Monetary and Financial Law Division in the Legal Services Department at the South African Reserve Bank. He also chairs the MPG legal workstream and plays a pivotal role in guiding the legal aspects of South Africa's benchmark transitions. If I could request that our panelists make their way to the stage, please. Please give them a round of applause as they make their way. Post-lunch drowsiness kicking in. The moderator is not Mluleki. It is, apologies. It is Paul Burgoyne. Paul is the head of Treasury at Standard Bank South Africa. He's also lead of the MPG Transition Planning and Coordination Workstream. Thank you.
No problem. Thanks. Good afternoon, everyone. It's great to see the sort of full house after lunch. I think this is going to be a very topical panel. So just to introduce the panel, we've got AK Ismail from SA Home Loans. He's the Director of Debt Capital Markets and Treasury at SA Home Loans. Kedibone Dekokwe, Divisional Executive of Market Integrity and Decision Science at the FSCA. Mululeki Shongwe, Head of Monetary and Financial Law Division in the Legal Services Department at the SARB, and Ivan Ruskchek from First Rand Treasury with a focus on liquidity strategy, liquid asset portfolio optimization, and transfer pricing, which Zoronia hits all of those squarely. So I think Tough Legacy, I actually thought it would just be worth reading out the definition in your pack. So tough legacy contracts are financial agreements that are significantly challenging to amend or renegotiate to reference an alternative rate after Jibar ceases. These contracts often form part of complex transactions or arrangements and may involve multiple parties, making it difficult to secure the necessary consent for changes. So we're talking about things that are significantly challenging, and I think SA Home Loans is a great example of the multiple complexities that can exist in this type of transition, and some of the challenges the industry's had to work through in assessing this. So, AK, over to you. Let's hear about your special case.
Thank you, Paul. Afternoon, everyone. Hopefully the energy levels are pretty high after lunch. Let's dive straight into it. Okay, let's set the scene first. Who are we? We're the biggest non-bank mortgage provider in South Africa. Opened our doors about 26 years ago. Since then, we've put 300,000 South Africans in homes, and we currently serve about 125,000 families all across the country. How are we different? Well, why am I up here? We provide home loans that are linked to Jibar. So unlike most of the retail credit space that uses prime, we use Jibar as the base rate for mortgage loans. Why do we do that? Well, it gets into our funding model. As a non-bank, we don't have access to deposit funding. We have to be very clever about how we tap into deep pockets of liquidity. Capital markets clearly is a key source of funding for us, and securitization is the most effective way for us to tap into capital market funding and thereby providing a bridge between institutional investors and South African households. Now, we know that capital market funding, DCM funding, predominantly Jibar linked, hopefully for not too much longer, to achieve basis matching between assets and liabilities, and therefore being able to avoid a hedging cost layer. What that allows us to do is pass those savings on to homeowners. So we're working in a market here where pricing is key. Changes in rates, borrowers are very sensitive. To the extent that we can eliminate that cost layer, power to the people, right? Okay, in terms of our approach, we've had a securitization platform now for almost 25 years. We've probably raised about 70 to 80 billion rand. We're a very conservative institution. We don't like taking risks, and I think to our benefit, even with GFC, with COVID, no investor has ever suffered a single rand of losses in our deals. And that's because we are grounded in stability, sustainable value creation, very, very low tolerance for risk, and that's very pertinent for the upcoming transition. Okay, so I think we already know why it's interesting. Let's get into the weeds of why Jibar transition is particularly interesting to an institution like us. The Zaronia conundrum. Okay, so right out the gates, Jibar's natural successor, Zaronia, at least when converted to a term equivalent, is just not suited for retail markets. These agreements are governed under the National Credit Act, which loosely says rates need to be known in advance, and we can understand why. We are not talking about counterparties that are walking around thinking about interest rates all day. They need, from a cash management perspective, need to understand their rates in advance. And the terms must be easily understandable. Now, I don't know whether this next point is going to land as well, given what we've heard so far today, but at least from our perspective, can you imagine inserting this into a home loan agreement? Ivan has explained this to me 10 times, and I kind of get it. We would rather not burden our fellow South Africans with this level of complexity. So not fit for purpose. Okay, so if we now try and reframe this into a transition strategy for home loans, we know that we need to identify an alternative, equally robust replacement rate. We have to update or transition over 120,000 individual home loan contracts, and we have to do that in a manner, now if we put our TCF hats on, in a way that delivers a frictionless, seamless, commercially neutral transition for each and every one of those customers. And the clicker is not working. Let's try it again. Ensuring fair outcomes for all. Okay, so that's already quite a bit of a job, right? We then summarize by saying our transition objective is to move our home loans to a robust alternative replacement rate in a manner that preserves value for our business and delivers fair outcomes to every customer. Okay, now let's consider the other side of the balance sheet. I mentioned that securitization is our primary method of tapping into capital market funding through the use of securitizations. Now, where it gets complex is we've got a 35 billion rand book on our balance sheet, and that's not sitting in one entity. Each securitization is bankruptcy remote from each other, and we've got about 18 of them. So think about this. You've got 120,000 home loan agreements spread across about 18 different special purpose vehicles, each with its own controls, each with its own rules. So it's not as easy as just changing one institution. There's actually about 18 that need to transition. Okay, so why are securitizations difficult or challenging? Well, we know that securitizations are facilitated through special purpose vehicles. They are essentially designed to run as bankruptcy remote autopilot structures. There are no employees in securitizations, and therefore everything needs to be highly, highly prescriptive. almost like a piece of computer software. The way securitizations are built, and for those in the audience that are on the investor side, the reason why securitization program documents contemplate hundreds and hundreds and hundreds of pages is because that level of prescription, surgical precision, is necessary. What this practically means is that when building the securitization and when documenting it, we have to think about every possible outcome that could emerge from every possible permutation, contemplating every possible change in every variable. So the computer software analogy is key. When you're designing software, you're not contemplating one use case, you're contemplating all possible use cases when designing it. Okay, so think about our securitizations as these pre-programmed structures all designed to run on autopilot. Okay, now changing them, not easy. As prescriptive as they are, we didn't think about a world where potentially the base rate would move from a forward-looking to a backward-looking rate. Suddenly, some of those rules in the securitization start to say, hold on, I thought you were going to give me the base rate at the beginning of the interest period. You're now telling me it's coming at the end, and there are certain scenarios that don't get accommodated. Okay, so some of the lines of code break and need to be reprogrammed. Now, at a technical level, it's not difficult. It doesn't shake the foundations of the securitization, but the process of changing the securitization, that's where all the complexity emerges. I think we've already spoken about DMTN programs, especially when you're listed, when you are in the DMAT space and you're working through straight, when you've got a diversified pool of investors, you need to solicit consent. In our world, you can throw in rating agencies. Vast majority of our deals are all rated by Moody's. It's a very complex process. We like to use the tools available. I think we were the first to use the straight e-voting platform back in 2023, and it really does help. So just to echo what was mentioned earlier, start sooner and use the tools that are available. If you need to remediate, to be Zaronia compounded in arrears ready by 1 April. In our world, if we just take a step back and think about all the different gatekeepers that are in place to make sure changes to securitizations don't have any unintended consequences, that can translate into a 6-month lead time for one deal, and we've got 18. So once I've got the technical solution, we'll call up all the banks, or partner banks, we'll model the solution, we'll test it with the rating agencies, we'll get the lawyers to draft it, we'll then go through the JSE process, solicit consent, and only thereafter can you actually go live. So getting this done across 18 deals, there's a lot of operational risk, and certainly is going to put a lot of pressure on the system that's already going to be quite strained as we get into the meat of transition. So, our transition journey, we've talked about the home loan space, 120,000 contracts. Every single customer needs to be walked the journey. Difficult in its own right, and now you couple it with the complexity of securitization. The interesting thing here is that you can't divorce the two. The transition objectives for these residential mortgage-backed securities comprising home loans and various listed, rated debt, their transition objectives are interconnected. If you transition one without the other, you could have a problem, regardless of which side of the balance sheet you are dealing with. So what we quickly learned as we started to think about our transition plan is synchronous transition is key. To avoid a scenario whereby you can't really control the pace of transition, given the diversity of underlying contracts, the fact that they all run at different paces, achieving synchronous transition is very difficult in those circumstances. And of course, basis risk, we've talked about it a lot. Basis risk in itself is not scary. I mean, we can put together hedges either at an individual securitization level, or we could do portfolio hedges. Where it gets complex is where you're dealing with unpredictable basis risk. You've got home loans that amort at a certain pace. You don't know exactly where each home loan, as they're transitioning, is sitting. There's 18 structures. We'll know. We can't predict which one will transition when in an active transition scenario. So wanting to control the pace of transition is very important to managing basis risk in a manner that can be predicted and therefore hedged in a viable manner. Okay, so let's go back to our transition objectives. I won't repeat the home loan one. If we now overlay that with our securitization platform, we need to transition the platform in a manner that preserves the structural integrity of each one, preserving investor confidence in the process, maintaining our position as the leading issuer of listed securitizations in SA, while managing basis risk in a commercially viable manner. Is it sounding complex yet? A little bit. Okay, let's simplify it. Okay, so what we have to do is transition over 120,000 home loan agreements and the securitizations that are funded in simultaneously. Still sounds a little bit too complex for me. Let's simplify further. We transition as a system, not in fragments. We could do it in fragments. The level of risk associated with that scenario is above our risk tolerance. A synchronous transition at a system level is what delivers the transition objectives that we see as being optimal, and certainly ticking all the boxes under the mandate we've been given by our regulators, and that's to achieve an orderly transition, not to impose an undue burden on any one of our category of stakeholders. We know very clearly synchronous transition gets us there. Okay, so system-level transition is what we need. Let's think about how we achieve that in each of the three transition mechanisms. We know that active, passive, and legislated are the three potential pathways. Let's think about our transition objectives through the lens of each one of those three. So for this exercise, we'll ask, in each scenario, did we achieve an orderly transition? Did we achieve economically neutral outcomes for all stakeholders, no value transfer? Did we as a business transition in a commercially viable manner? And did we maintain compliance with all applicable laws? There are, of course, other transition objectives. These four are the most relevant. So in an active scenario, just to recap what that means, renegotiating 120,000 contracts, doing surgery on 18 securitizations, and trying to manage the pace of transition across all those different contract types. Right off the bat, this doesn't sound like a system-level transition, does it? So our assessment, does this allow us to achieve orderly transition? We think not. Do we achieve economically neutral outcomes? We say we're uncertain. Why? Our risk tolerance is such that if one customer gets a bad outcome, that means we don't tick that box. If we get 119,999 out of 120,000, that's still not acceptable. So in a scenario where you are doing all of this manually, case by case, walking each customer through the journey, the operational risk is what causes me to put a question mark on that box. Transition costs, I think here it's a clear no, just given the scale of the endeavor. Do we maintain compliance with laws? I say question mark because whilst we understand the laws, we know how to comply with them, again, the scale of the endeavor means that the risk of a misstep is too high, certainly beyond our risk tolerance. So, system-wide transition is unlikely. How about passive transition? So, when we started this journey, we thought, well, we've got fallback language, right? We've got mirrored fallback language between assets and liabilities because we thought, well, post-transition, basis matching is maintained. Now, of course, we ask ourselves, is the fallback language adequate? Does the fallback language contemplate a determining person? Does it contemplate polling banks for rates? Now we think that the vast majority of contracts, beyond our business, for legacy stock won't be seen to have adequate fallback language. So what that means for us is that passive transition still requires amending more than 120,000 contracts, but we've got a bit more time to do it. Just before cessation, where contractually those contracts would fall back to the chosen rate. In this scenario, I'll speed run through, and our answers to each one of those 4 questions is, again, we understand the technical answers very well. We know how to implement it, but the operational risk is higher than our threshold. Possible to achieve synchronous transition, but risky. Okay, so that brings us to legislated transition. In this scenario, we're not renegotiating contracts individually. Legislated safe harbors, I think, if and when enacted, will allow for the transition to happen at a system level by operation of law. What would happen in this scenario, and Lou will expand on this, is that there would be designated replacement rates, adjustment spread, and importantly, conforming changes for each category of legacy contracts under directives issued under the new powers granted by those amendments to FSRA. In this scenario, we can avoid doing surgery, we can avoid a messy transition, going through contract by contract. It's orderly. It reduces the operational risk of making sure that there's an economically neutral outcome for all. It allows us to manage transition costs effectively, and certainly, again, from an operational risk perspective, reduces the risk of us not complying or maintaining compliance with all laws and regulations. It's a coordinated effort to achieve a synchronous transition across the system. Okay, I'm 38 seconds in the red, so I think this is the good time to move over to our panel discussion. Thank you, everyone.
Great, thanks, AK. I think there's a lot of learnings and principles and thoughts you've applied in terms of how to effect transition that everyone in the room can take out. So I think the way I'd like to structure this discussion is, AK, I've got one question for you, and then we'll go directly to Mlu, who, as we heard this morning, there's some hot news off the press regarding the legislation. Then we'll get Ketabone's thoughts from the FSCA, and Ivan will give us some thoughts on some of the practical aspects around the safeguard provisions. So I guess with this, there is this complexity. We're going to hear more about the detail of the legislative amendments, the safeguards provided in that. How are you thinking about adjustment spreads? Or is it too early for you to do that, given there's still some uncertainty in your world?
Yeah, so I think let's take each side of the balance sheet individually. In the retail space, firstly, firming up what that successor to Jibar is in the retail space, potentially a term Zoronia. Firming that up, of course, is the first step. In terms of how the adjustment spread would work, I think we're well placed because we've just been through 2 years of learnings on how to apply an adjustment spread, I guess in the case of Zoronia overnight or compound in arrears. From a technical perspective, that wouldn't change. What would be considered in the retail scenario is how that adjustment spread manifests in that home loan agreement. And given that we're dealing with homeowners, we're not dealing with institutions, the way that's communicated, i.e. the replacement rate and the application of an adjustment spread, and why that achieves a commercially neutral outcome for each of those customers, I think that's where the focus for us is going to be. One of the things we set out to do when putting together our comms plan is to say, we've been in the institutional space over the past 2 years talking about Zaronia. There's still some learnings for us to better understand how everyday South Africans are thinking about this. And as much as we'd like to think that outside of this room, people are thinking about market interest rates as much as we do, the reality in the world around us is it's not really on the average South African's mind. So education is key, making sure that we communicate the principles that we've all been discussing here in a way that is clear and consistent. We see that as a key area of focus so far as adjustments are concerned. On the securitization side, remember the bonds that are issued out of securitizations are no different to those issued under DMTN programs. The securitization itself, however, requires a little bit of reprogramming, as I mentioned earlier. Structural features that are designed to reference rates at different points in the securitization's life cycle means that it's not just the notes themselves where you have to apply the adjustment spread, but also at a structural level, you have to ensure that where it was intended that a certain reference rate was pulled in for purposes of a calculation, that now the replacement rate gets supplemented with an adjustment spread to make sure that that calculation still operates as intended. So in summary, I would say from a home loan perspective, it's about the nature of the engagement that we have with our customers. And at a securitization level, it goes beyond what we've all been seeing over the past 2 years, and it's making sure that adjustment spreads are threaded through the securitization effectively.
Thanks, okay. Mlu, over to you. Maybe first up, we've heard about the scale of Jibar-linked mortgages. SA Home Loans is not the only institution with Jibar-linked mortgages, and there's a wide securitization market out there. There's been a lot of discussion through the MPG on securitization as well. There's guidance coming out regarding that. But what are some of those critical legal risks that the legal work stream has seen around this, around contract continuity, fairness, and potential disputes that may arise?
Yeah, thanks, Paul. Before I speak about the legal risks, I have to thank the teams who have helped us to draft the legislation, particularly Lionel Shaw, the teams from National Treasury, the FSCA, members of the legal work stream for contributing to the drafting of the document and to ensuring that it was published timeously last night. On your question, there's two legal issues that we are concerned about. One is legal certainty. So we want to ensure that come 31 December next year, market participants have legal certainty around the legal terms that will apply to these tough legacy contracts. And in that regard, we have introduced some provisions in the draft law. It's actually called the General Finance Amendment Bill, for those who'd like to read up on it. It's been published on the National Treasury website. But in that law, we have introduced some powers to the Reserve Bank so that they are able to identify categories of tough legacy contracts and to designate alternative benchmark rates, credit adjustment spreads, conforming benchmark changes, and so forth. We've also given some powers to a determining party who has been recognized as such in a legacy contract to be able to make certain determinations regarding the treatment of those contracts. So that we think will help us achieve legal certainty. The second legal matter relates to liability risk and liability risks that can arise out of litigation. In that regard, we'd like to ensure that following the cessation of Jibar, you do not have market participants who attract liability as a result of having implemented the transition. In that regard, we've introduced some clauses that talk to limitation of liability in the legislation to ensure that no person can claim losses or damages as a result of having implemented the transition. So those are the two main legal issues that we're dealing with.
Great, thanks, Mnu. So we'll have various categories of instruments or asset classes that may be treated slightly differently. We like to have Soronia plus a credit adjustment spread where that makes sense. In certain other cases, SA home loans or retail markets in general may be a different case. We've got the safe harbor provisions for the contractual amendments that are going to be taking place under that legislation. I think that's quite clear. I think the next steps, obviously, is to work with the industry on setting up, fleshing out that detail to provide market that certainty. Do you want to comment on that briefly?
Yes, certainly. So what we've done in the legislation is also to prescribe what will be the effect of these tough legacy contracts at the Jibar cessation date. And so to deal with the issue of legal certainty, we do say for those contracts where there's no fallback language or fallback language that is not robust, and we actually go into detail on what we regard as fallback language that is not robust. For instance, if you haven't identified a determining party or a replacement benchmark rate, etc., those type of contracts will be treated as tough legacy contracts. And like I said, the sub will then be able to identify those contracts, prescribe what replacement benchmark rates and other terms such as benchmark conforming changes will apply to those contracts, and therefore they will then get treated as contemplated in the proposed amendments. Like Rashad said earlier this morning, the sub will consult when it issues these draft notices to the market. For the various products, we may prescribe different benchmark rates, but market participants will be able to comment on the draft notices before they become law.
Great, thanks very much, Mnu. I think that's provided a lot of clarity around that. I'd urge people to look at the legislation, comment on that, and through the MPG, then feedback into these notices that come to the market in early part of next year. Maybe Ketebone, coming across to you, from an FSCA perspective, we've heard from AK, but conduct and consumer protection, those are critical as part of this journey. Can you elaborate on some of the safeguards you'd expect firms to have in place when repricing Jibar-linked products? Especially maybe with reference to NCA, we've seen that as a particular issue that's hit the retail market. But it'd be good to get your thought on that and sort of broader fairness principles that should be applied.
Thank you very much, Paul, and thank you for the invite. I think AK has outlined some of the important points that we expect that will address our retail market. And one of the points that you have mentioned is communication, which is key. And if we, or I may ask any one of us in the room, whether we are aware from our mortgages that we have that will be impacted by this transition. Do we know or not? And out of all these learned minds, what about the man on the street? And where do you start as a home loan to explain the concepts and make sure that the mortgagers understand and they are well aware of what should be a fair outcome for themselves? So communication is essential for us, and it must be clear. It must include the notices that we'll be sending out to our customers. It must also outline the complex methodologies that you mentioned, and also explain how those methodologies function. It must also talk to the operational impact. And at the end, I'm sure it will also affect the pocket of those customers. But whether it's, what I'm outlining is true or not, but they need to know if that would be one of the impacts. So they must be equipped to understand. They must know how this transition will start and when they can expect its implementation. From a communication point of view, we will then look at how these contractual changes affect them. Are they fair? And is there clarity that is provided to those customers? We need to make sure that when we update the terms and conditions, we are accurate, and we are also going to make sure that those terms and conditions reflect the nature of this transition that we are expecting. You also spoke about unintended consequences of value transfer, and we also support that when we do communicate, those spread adjustments must be transparent, they must be justifiable, and they must be aligned to the market consensus. In summarizing, I would say that from our side, we expect this transition to be transparent, to be well-governed, and also to protect the financial customers at the end of the day.
Great, thanks, Ketibone. I think you've covered those principles really well. And Lou's taken us through, the framework of the legislative amendments. Is there anything you want to add to that, or also talk about in terms of the benchmark regulation and any amendments to that, or the introduction, of the benchmark regulation that would support the tough legacy contracts?
The benchmark regulations, we are still at the infancy process. We haven't published anything from our side, but we are working together as the regulators to come up with the conduct standards or the joint conduct standards. What we are currently focusing on is the amendments to the FSR amendments that you have mentioned, Lou. But from our point of view as the conduct regulator, we are saying these amendments, they are going to be very important to eliminate ambiguity that might be there. They are going to prevent inconsistency in terms of each institution's interpretation. And also they are going to reduce the risk of disputes or opportunistic approach that entities may have in repricing.
Great, thanks, Ketibone. Okay, so we've got a view from the FSCA. We understand the legislative support. We understand that we prefer to transition actively or passively, and then we have these legislative protections. I think the legislative amendments are wide-reaching in terms of their impact all Jibar instruments. I think that's important to note as well. I think all Jibar instruments will find themselves into one of those categories and be treated accordingly. So it's a wide-ranging, has a large impact in terms of its effect. We spoke about Zoronia. We've spoken about the applicability of a term rate that gives more predictability, and we're on that path, and it's, we will hopefully get to that point. I think we're clear on that. But in addition to that, Ivan, if I maybe come to you, in the event that we don't have that term rate, there have in other markets been discussions around the use of a synthetic Jibar. The Deputy Governor referred to that in his opening remarks. Can you give us a sense of what the role of synthetic Jibar might play? Some of the discussions have been had around the design of a synthetic Jibar and what scenarios it might be used. It's unlikely it's going to be used broadly, but how might it be used at an industry level?
Yeah, thank you, Paul. Synthetic Jibar may actually even be needed if we do even find a forward-looking term rate. So you should still need synthetic Jibar because the real need for synthetic Jibar, so what is its role? Its role is there to protect the market from a disruption. So if 120,000 home loan owners don't know what to pay, that's a disruption event, and we need to protect against that. So synthetic Jibar is really nice in that it's basically a rate that you can search and replace and put it in place of Jibar. Okay? So that makes it very usable, easy to put into a contract. But we want people to transition. We don't want everybody just to say, okay, we're going to wait for synthetic Jibar and nobody goes to proper Zeronian. So high synthetic, so let's just talk a little bit about the design. So there's first the regulatory and the legislative design. So from a regulatory perspective, the draft conduct standards for benchmark administrators say that the SARB can actually publish a benchmark, so they can do that. So they can publish synthetic Jibar, if it is called synthetic Jibar. I can't think of a different name. And then the legislation that has been published now, that was very well written, and I've read it a few times because I'm trying to understand the legal terms, and Mlu will correct me if I'm wrong. But essentially the legislation says that the SARB can determine and designate that synthetic rate. Okay, so they can determine what it is and how to designate it. So they will say, okay, these contracts we're going to have fall to synthetic Jibar. The other thing is they've had it as a replacement rate to a rate that is no longer in existence. So what that also does is it's a replacement rate for something that's disappearing. And the legislation, I think, is also very clever in that it ceases Jibar. So the point is, if you go and create a synthetic Jibar, how has it ceased if you go and create a synthetic thing? So I think the legislation is smart enough to say that even if we create a synthetic Jibar, that Jibar has ceased. And all those fallback, all that fallback language still works. It will fall back to the normal fallbacks. Okay. So that's how the regulations and the legislation basically transmits this new synthetic Jibar into contracts. Okay. And it can only be inserted into legacy contracts. It cannot be gone and used for new contracts in the next year. It is purely a rate that is meant for synthetic contracts. And quite often, synthetic Jibar has also had a lifespan. So it could be a year, it could be 2 years, I'm not sure. The legislation has allowed for varying times. But essentially, synthetic Jibar is also something that is meant to give the industry enough time to transition those difficult trades. It's not there to replace a rate indefinitely. So I think that's how synthetic Jibar is designed from, say, a legal and a regulatory perspective. Okay, now let's go on to how maybe it could be calculated. So in most markets, the forward-looking term rate has been used as the underpin for that. And the forward-looking term rate was generally done in one of two ways. It was either using futures in the US. Essentially, they would do a calculation between the futures and work out what 3-month SOFR would look like. And then in the UK and in Europe, what they did was they used single period OISs. And generally, there were combinations of quotes and trades. Okay, so trying to make sure that those forward-looking term rates are representative and they're based on trades, not just quotes, so that we don't have a similar problem that we had of having a purely quote-based rate. Okay, and then, I think I think that explains that. But really the important thing about synthetic Jibar is it's an all-in rate. Because a lot of people have always asked me, why not just use the forward rate? Why don't we just use the forward-looking term rate plus the CAS? But if I go and give that to AK, he's going to struggle because it still means that he's got two numbers that he needs to go insert into a contract, and there's covenants, and there's all sorts of strange things where you need to insert it. So it makes it a little bit more difficult to designate the forward rate, the forward-looking term rate plus the CAS. So synthetic Jibar is really, it's the last thing where you couldn't remediate a contract, and the set of fallbacks don't work, okay? Then you use synthetic, and the SARB will determine who can use that rate.
And Ivan, sorry, I'm going to put you in a difficult spot.
Yeah.
And, you know, we've obviously gone out to tender RFP for a term rate administrator. There are some risks associated with getting a term rate in place by cessation. We do need, I think you've articulated the case for a synthetic Jibar, let's call it, as an ultimate backstop from a legislative perspective. What are some of the other considerations if we don't have that term rate? I think we would largely agree in through our discussions that building a synthetic Jibar off the term rate makes the most sense. What are some of those other alternatives?
Yeah, so I mean, I think we'd have to work quite hard at that. But an alternative is, potentially to try find 3-month contracts. Maybe they funded contracts. There could even be the alternative to continue to publish a Jibar of sorts, but it's unrepresentative. So nobody can use it for another contract, but essentially we don't feel that this is a representation of the underlying financial markets and the economics of it. So you could still create it, but almost make it unusable in contracts because, and it could only really be used for synthetic purposes. So that is a solution, but hopefully it's a solution that we don't need to look at. But there are, I guess, alternatives there. I don't think that the average rate is very good. So there is a term rate. There's a backward-looking average term rate, but that the SARB does publish. But it's maybe less market-friendly, given it's almost a fixing because it's the average of the last 3 months, Zoronia. So not as useful as a reset as we know it.
Great, thanks, Ivan. I think that provides some of the complexities and the interlocking discussions that still need to play out, actually, in terms of
absolutely. And I'm not a legal expert, so Mlu, please correct me if
any
of those things were incorrect.
I was actually going to say, Mlu, is there anything you would like to correct at this juncture or contribute or add to what I think Ivan's explained the synthetic Jibar situation very well in quite simple terms. Anything you want to add to that at this point? Not really. Okay, so we're doing well for time. We've got some time for questions. So please, if there are any questions from the audience, I'd love to hear them. I think lunch is still digesting. Maybe going once, going twice. Okay, well, thanks very much to the panel. I think this is a difficult concept. I think I really appreciate the work as well at an industry level to put these safeguards in place and allow for more, contractual certainty around transition. Thanks very much.
Sorry, I have a question.
Fantastic.
I wanted to ask, what other examples of tough legacy contracts do we have? I know SA Home Loan was a good example. I always thought like most home loans reference prime. And now I'm finding out something else. So what other contracts would be considered tough legacy contracts?
Does anyone?
Yeah,
Ivan, do you want to?
Yeah, I'm happy to take that. I think I was actually meant to answer that question when you asked it. So it's a good thing I left it out.
Good question.
Yeah. Other contracts. So obviously the home loans referencing Jibar a good example, but there are commercial loans also referencing Jibar and securitizations on those. So we have those as well. And I think potentially finance can also sometimes reference an invoice discounting. So if you have a facility that's maybe a year long and you need to discount a rate, you need to know today. So you need a term rate in order to discount it. And I think that that's a good example of where you can't easily just say in a trade finance or an invoice discounting trade, oh no, just use the floating rate and we'll tell you at the end because you need to discount the invoice today. So I think that's quite a good example. Yeah, I can't think of too many others.
Just was a question, examples of tough legacy, other examples, just to be clear. I mean,
yeah,
I think...
Yeah, that was for synthetic.
Oh, for synthetic,
but
sorry.
tough legacy, I think there's a host of examples. I mean, there could be bonds you can't remediate. There could be or bonds you can't get consent solicitation. There could be loans that are in liquidation. You know, companies in liquidation aren't able to easily, vote or change the loan documentation, get signatures, those sorts of things. So there are quite a few cases where I think that there are tough legacy.
One more question, and it's probably too early for Lou to answer it, but along those lines, with the SARB notice that will be coming out early next year, and to Yvonne's point, is there any intention for the SARB in those notices to actually, as Yvonne's just done, provide some guidance to the market? Because we're facing a lot of questions at the moment from people going, well, all our products are tough legacy because they're going to be difficult to remediate. And so there certainly seems to be a bit of sitting around waiting for the legislation to solve those contracts that aren't by definition tough legacy contracts. So will there be guidance, is the question.
Yes, Justin. So the SARB, through the MPG, will work with market participants to identify these contracts or categories of contracts, to identify suitable replacement benchmarks, suitable benchmark conforming changes. And once that detail has been finalized, we'll then issue the draft notices for public comment. In terms of the proposed legislation, we have to issue the draft notices for at least 30 days, so you'll have a month to consider and provide comments before we issue the final version that will become law. So you will have an opportunity, like Rashad said, we'll consult. Thanks.
So perhaps, Justin, perhaps part of your question is, how tough is tough, right? If I have to phone a lawyer to get something done, or I could just let the legislation come in. So will there be some sort of thresholds considered, or some almost definitional characteristics to the guidance?
In the draft legislation that got published last night, you'll see that there's clarity around what constitutes robust fallback language. So to the extent that you require to have a poll or send queries around pricing and so forth, automatically by law, those contracts will not be deemed to have robust fallback language, and therefore the provisions of those amendments will apply. So in a way, we have sifted through what we would consider as fallback language that is not robust and which would be captured.
Thank you.
Okay.
Good afternoon. I think it's been answered, but we sort of represent a lot of corporate lenders and corporate hedging companies, let's just say generally, or project finance companies. And they obviously have used the Jibar interest rate hedging market significantly, and the one thing I noted on the one chart, I forget who put it up, but it seemed like most of the SA sort of Jibar derivatives were, I think it was only about 20%, that was above 2 years. Would synthetic Jibar cater for, resets against fixed rates that were Jibar related? For instance, there's swaps that are running out over, say they don't quite finish in December next year, but say run out to June 2027. Would that be a criteria that would be considered to allow people to use synthetic Jibar to benchmark those swaps until they fall off, instead of having to go through the process of converting them to Zaronia swaps?
I haven't seen derivatives being allowed in the synthetic space, so it's mostly been retail, middle market, and trade finance type deals. I haven't seen in any of the jurisdictions where that's done. The one thing I may ask is then, if there are hedges, does it actually doesn't matter as much if you have a floating rate now, or do you need that 3-month certainty?
No, it definitely matters for them. But if they have converted their underlying loans to Zaronia-based loans, then they will obviously transition.
Exactly.
But these guys, they've got, they're just asking us, okay, can we just close our eyes and hopefully this goes away?
I think ideally they would move in lockstep, but if there is a bit of a gap, then that is a risk that you run, and that's why active transition is so important, that you engage your hedge provider, engage your loan provider, and try synchronize those changes. If you close your eyes, then absolutely you might have a bit of a mismatch.
I think maybe from a financial institution perspective, we're fully expecting to have to transition all of our derivatives that are going to be in existence beyond 2026. And we'd engage with our clients accordingly. Yeah. So we haven't obviously finalized the implementation of the legislation, but of the guidance regarding that, but I would expect we should plan around having to transition. Great, thanks very much, everyone. And thanks to the panelists again.
Thank you.
Thank you very much to our panelists for those insights. The conversations that just took place remind us that benchmark reform is not only a market exercise, it is also a consumer protection exercise as well. Our next panel is on managing risk during